let's talk about another structuring topic, but really for 8 and 9 figure entrepreneurs who have that liquidity event or really who want to create their own family office and family office structure. We're going to talk through the tax benefits and tax court cases that legitimize a family office LLC, as I'll call it. But before we jump into that, Jim, I think it'd be useful for you just to maybe tee up what is a family office and why would an entrepreneur, even if an 8-figure or 9-figure entrepreneur, not a billionaire, want to create or mirror a similar structure to the Billionaire family office?
Yeah, and the Billionaire family office, which was started by John D. Rockefeller in 1882 when he was worth about $18 million, which was a lot of money in 1882. And he had this same problem that entrepreneurs have, which is over your lifetime as an entrepreneur, you pick up an attorney, an accountant, an insurance agent, a banker, an investment advisor. And if you get all these professionals and you picture those like spokes on a wheel, they're usually not all A players. They're not talking to each other. There's no collaboration. No one's holding them accountable. And the worst part is the entrepreneur is in the middle of that wheel trying to manage that team when they don't have the time and the expertise to do that. And that's what John D. Rockefeller found himself in the middle of that, what we would call a financial flat tire. So what he did is he said, I tell you what, I'm just going to hire all these professionals that I need as full-time employees just working for me and my family. I'll put them in one office building and I'll call that my family office. So that's where we believe the term was coined 140 years ago. And every billionaire has followed suit because when they're employees, you can manage them, control them, hold them accountable, and also have a collaborative and coordinated effort. And so, of course, what we do is we help that way with a fractional family office. But to your question, when he made that transition, then you're running a little bit like a little company that's running your wealth. And we see that with entrepreneurs that, often are post-exit, or they've established maybe a 9-figure balance sheet. Maybe they're making millions of dollars in income every year, and they need more support. And so how can you do that in a way where you can actually create some tax deductions? Because often they just pay a bunch of people, and that's fine, but there's a way you can do this in a more tax efficient manner. And that's something I think that you're going to cover here today.
Yeah, exactly. And so just to provide the tax framework here, there's section 212 of the tax code. And this was essentially your miscellaneous itemized deductions. And in the old world, which was pre-2017 Tax Cuts and Jobs Act, which was President Trump's last tax bill, you were able to write off your investment management expenses, investment research, portfolio management expenses, if in aggregation, all of these things were over 2% of your adjusted gross income. Well, that disappeared with the 2017 Tax Cuts and Jobs Act. So now, if you're just working with a Morgan Stanley or Merrill Lynch or any typical advisor charging you 1%, you're not writing any of that off. And so where you want to do is get to section 162, because section 162 of the Internal Revenue Code is what defines trade or business. Now, deductions are available for ordinary and necessary. That's what's always said. Is that an ordinary and necessary business expense paid or incurred during that tax year? And so what you want to do when you're creating this family office LLC or entity, or like you said, this kind of small business, is you want to make sure you're hitting the requirements of section 162 trade or business. So said another way, you want your family office LLC to provide services in exchange for revenue, not just managing your own money. And there's a really good tax court case. This was Lender Management LLC versus Commissioner. So this is a 2017. And this really set the playbook for all family offices to legitimize the ability to say, hey, managing my wealth, if I'm setting this up appropriately as a Section 162 trade or business, can drive legitimate deductible expenses. And so what this tax court case was a family office that managed assets for multiple family branches. They hired staff, maintained their office, produced reports, and they had, importantly, formal management agreements with performance-based fees. So just like any other professional who was managing assets, they were charging a management fee, they had carried interest, right? They were monetizing the investments of the family office. And so when the tax court case looked at this, they looked at the fee structures that resembled commercial investment firms. So, 0.5% to 1% AUM, they had performance fees, they had formal documentation, so written investment management agreements, they had a dedicated staff, compliance procedures, investment committees, and then they also provided other, and services outside of just investment oversight. So cash flow management, tax planning, estate planning, all of that kind of stuff.
And by the way, all that stuff sounds like a lot, but this is stuff that would be smart to do anyway. I mean, you really want to have your stuff dialed in. If you have a large balance sheet, You want to have the way it's being managed and the people who are helping you want that dialed in, which is what these things would do in addition to set you up for deductions.
Yep, exactly. And then this contrasts with the Higgins versus Commissioner. This was a 1941 tax court case where the taxpayer tried to write off investment management fees. But in this situation, the tax court case deemed that these management fees were simply reimbursements. There was not an actual service agreement, and this was not a Section 162 trade or business. So,
and just by the way, in 1941, I was very young.
Very humble. I appreciate it. So where we're at so far is that there is a framework using the lender management LLC versus Commissioner tax court case. There is a framework whereby 7, 8, really mostly 8, 9-figure entrepreneurs, and we work with some, we're going to go into a case study here in a bit, can set up these family office LLCs if they do it right? You got to dot your I's and cross your T's, but it flips the expenses that are affiliated with managing your wealth and growing your wealth from non-deductible to deductible. And then that's really the angle here is the tax angle. But on top of this, as we're going to talk about, it actually really also helps from a intergenerational wealth transfer perspective, because now it's easier to incorporate your family within this family office LLC and the governance that's created as part of this entire legal operation build out.
Yeah, very smart.
All right, so let's talk through how you actually do this. So we're going to go step by step. So the first step you're going to want to do is create, let's say, an LLC. All right. Now, most of the time you're going to want to create this LLC in a state such as Wyoming or South Dakota, because if you're a 8 or 9-figure balance sheet entrepreneur, you care about your privacy. So Wyoming, South Dakota, important there. Second thing you're going to want to do is, again, Section 162, ordinary and necessary. So we got to actually create revenue streams for this family office LLC. So this is where you're going to want to be providing, whether it's management services to the different portfolio companies or managing maybe properties, real estate properties, managing investments. And so you're going to want to structure this with management fees. You're going to want consulting services, board advisory fees, carried interest, right? The family office LLC needs to actually monetize and charge fees for the management and execution of all of the different assets that you as the family would be needing help getting managed. And all of this needs to be put into legal agreements, investment management agreements. So it's not just about theoretically moving the money around, but arm's length agreements executed and drafted by attorneys.
Yeah. And then the tax benefits as well as the other benefits we talked about are really helpful here.
Yep, exactly. And so now when you are building out different accounting systems, you've got the QuickBooks, QBO Online or whatever, you got full stack P&Ls, you got balance sheets. I mean, you're running this just like a business, right? You got revenue, you've got expenses, whether that's full-time staff, whether that's fractional staff. You're going to have a bookkeeper, maybe you have a fractional CFO or family office team, analysts, whatever it may be, office space, technology, whether you're on Bloomberg or Adapar, Orion, whatever it may be. So that is all going to be deductible here. So last thing let's talk about here, Jim, is the SEC registration decision, because we are registered as an RIA underneath with the SEC.
Yep.
And under 17 CFR 275.202A, that essentially has a carve out where family offices can register with the SEC so long as they are serving only family clients and they're wholly owned and controlled by family clients, and they do not hold out as an investment advisor to the public. So if they do that, they can be registered with the SEC, but they're an exempt entity. It's a family office exemption. So why would someone want to do this? The downside of registering with the SEC as a family office is you're now public, because all of this is publicly available information, right? Just like all of our information is publicly available as a registered SEC RIA. So that's the downside. But the positive of doing this is now it further could legitimize your case that this is a true family office, collecting fees, managing the family's wealth. It just adds more iron to the fire at the trade-off of privacy.
Yeah, and I think that's a case-by-case decision. I usually would say if all things are being equal, don't register.
Yeah.
If you have that option, but there are, as you said, real benefits.
And I think a lot of entrepreneurs ask, well, what stage should I create my own family office? Okay, hey, Dew Wealth creates these fractional family offices, but at what stage should I create my own family office, and how much do these things cost to build? And so this chart here that I'm going to show, I'm going to start at the low end. So a low end, and this is based off of Campton Wealth and RBC data here from 2025, a small family office is going to have 100 to 250 million. And so that really is the floor of when you're going to really even want to start thinking about maybe doing this, is 100 to 250 of kind of liquid net worth. And here it says that the average cost, annual cost for a family office, again, a small family office in this space, is $1.1 million, or as a percentage of the net worth, 62 basis points, or 0.62% a year. So again, if I was worth $200 million times 0.62, in that case, it'd be 1.2 million. So that's kind of the low end. Now, if we go to the high end, the very large family offices, these are those managing over $1 billion of net worth. So think of all of the billionaires we think about all the time. The average cost here is $9.8 million per year, right? So that's the cost, the burn rate essentially of this family office team, $9.8 million. They average 20 employees. But then the average fee is 35 basis points, or 0.35%. Now, of course, as you're getting a bigger and bigger number, right, in terms of your assets, you multiply that by a smaller and smaller percentage, and that's why that basis points will be lower and lower as you get larger and larger.
And you get efficiencies of scale, but still a $50 billion entrepreneur is going to pay more for his family office or her family office than a $1 billion entrepreneur. But it won't be 5 times it. It'll be less because of the efficiencies.
Yep. And so I think that as a rule of thumb, if you're an entrepreneur thinking of building your own family office and not going with a fractional family office or not doing it on your own, you're starting at 7 figures a year in terms of your annual cost. That's your annual burden rate. So you got to make sure you're getting at least $1 million of incremental value out of setting up your own family office. And here again, in that small size, which again is kind of, we see entrepreneurs that are buttoning up to this small size here. The average small family office has 3 employees, again, costs are just over $1 million a year, which makes sense. These are very high paid professionals that you're going to have on the team, and it's only 3 full-time employees, and then the rest would be outsourced.
Yeah. And you're still doing quite a bit of outsourcing at that level. The bigger they get, the more once you're in the billionaire status, they try to keep more and more in-house.